When you analyze a market, in my mind, you should have a systematic way to decide if it's time to be a buyer or if it's time to be a seller.
To me, that's like when you leave your house in the morning, you kind of have to know which direction you're going. You just don't blindly go outside and start driving.
Maybe you thought you were going somewhere, but when you came out and you look at the sky, it's raining. So in trading, it's the same.
Founder of Tradictive, Jose Blasco. Jose, how you doing?
Hi, everyone. I'm ready. Let's go. One of the beauties of trading is that it could certainly be approached in many different ways. But if you have a mindset similar to the way I think about trading, to me, it's all about bringing in consistency of results, which implies consistency of action, because consistency of results with random action would not be possible. So I always think about, I want to be consistent with results, let's have consistent action. And in order to have consistent action, then the formula is to be systematic, to have a step-by-step, rule-based type of process, right? So in a nutshell, to me, every time we are analyzing a market and planning on a trade, there are two steps you cannot miss. For sure, we can break them down and we may end up with a longer list than only two steps, but overall it's two steps. Today, we're going to talk about step one, which is basically to understand which is the right side of the market in which to be. Should you be long or should you be short? When you analyze a market, in my mind, you should have a systematic way to decide if it's time to be a buyer or if it's time to be a seller. That's, to me, step one.
To me, that's like when you leave your house in the morning, you kind of have to know which direction you're going, right?
Yep.
Before you step out the door, you have to know where you're going and which direction that is. And, for a lot of people, that routine is normal, right? Hey, I'm going to the same place every day because I'm going to work. But that doesn't always happen, right? Weekends, you have different things to do. You just don't blindly go outside and start driving. You have to know where you're going. And it's kind of the same thing with trading, right?
Maybe you thought you were going somewhere, but when you came out and you look at the sky, it's raining and you decide to go somewhere else or not to go anywhere. Or maybe it's sunny and then you decide to go where you were planning to go. So in trading, it's the same. Sometimes you have a market condition where you plan to do a certain action, but maybe there is no profit margin, or maybe the market is too volatile that day or not volatile enough. So there are a series of considerations in that step one, which basically leads you to understand, okay, time to be a buyer, time to be a seller, or no time to trade, which is also an important consideration because, it's not like we're going to be trading every minute. In a perfect world, that would be the case because the more active we are, potentially the more performance we're going to collect. But at the same time, quality and quantity, or another way to think about quality is probability. So quality and quantity, they may not come together. The high quality opportunities, typically they happen from time to time, where low quality opportunities, those happen all the time. So we need to be able to filter out what's good and what's not good enough.
I like the way you phrase that. Using probability as a way to measure quality, really, right? It's finding an opportunity that is highly probabilistic is certainly what we should strive for when we're looking at the trading day. And I've never really kind of put those two ideas together as a quality trade, but that's exactly what you're doing when you're looking for trades. You want to find the best fit, and is it supported by evidence?
Correct. I mean, our challenge as traders really is to predict the future, which cannot be predicted with guarantees. So in the end, it's all about stacking probabilities in your favor and then in parallel, having a good risk management approach. That way, when the prediction was not accurate, then we don't get badly hurt. And when the prediction was accurate, then we profit the most as possible. Therefore, we end up combining the three key elements, which is the probability of success with size of the winners as an average when we're right, with the size of the losing trades when we're wrong as an average. And then we come up with a formula that basically tells us, is our methodology making money consistently or not? Yeah, that's to me, in a nutshell, what being systematic means. And it all starts with that step one, knowing where you're going, as you said, and what's the weather today.
So what is your process? How do you go about determining what your bias is?
So in this case, I have a screen here with multiple charts. Maybe what I'll do to answer that question precisely is to go for a simpler workspace with one chart only. And then maybe I come back to a more complex or complete set of charts. What I have here is a 15-minute time frame of gold futures. It could be any other market, but that's the one I have at the moment. There are many ways on how to assess a market condition, especially depending on your techniques, including your belief system. Maybe the trader is a fundamental trader and has been listening to the Fed speaking today. Maybe the trader is a trend trader. Maybe the trader is a counter trend trader. Maybe the trader is a Elliott wave trader. Again, there are many ways on how to determine what your market condition based on the techniques you use in trading. Now, the problem is that many of the techniques that an average trader will learn from books, for example, imply a manual type of analysis. For example, here we can see this chart. So we have have lower highs, we have lower lows, but then here we also have a higher low, right? So some traders may determine this as a downtrend, some traders may determine it's beginning to go up, some traders may say it's sideways. So now we're coming in with some subjectivity, which is the opposite of being systematic. So we've developed this tool that we can see here in the bottom part, which is called AutoClimate. Again, going back to the analogy with weather I was using before. So what this is doing is looking at price action and giving you indications in the bottom part of the screen. There are two types of indications. The figures on the right, which I will explain in a moment. But before we get into those figures, we have either the blue or the red dots that we can see in the bottom. So basically a red dot we just got now means that we are in a down market, and therefore selling carries with it a statistical advantage. Again, in this case, it's my methodology. There's what I do. Another trader may address the market condition differently, and again, we are both predicting the future. So, one is going to be right, one is going to be wrong. My approach would be to run AutoClimate and not even think about it. If it's red, I want to be a seller. If it's blue, I want to be a buyer. Now, with that in mind, there is a bit more to it, right? It's nice that I'm being so simplistic at the moment, but sometimes too much simplicity leads to something a bit incomplete. So let's complete the conversation. Notice that there are times where the dots are thin, and notice that there are times where the dots are thick. So the interpretation of the thickness of those dots has to do with not only the market condition, but is it time to act or not? So for example, if we are in a situation where we got red dots, but they are thin, the intention behind this would be that you have a little bit of a market direction, but you don't have an impulsive environment. If you don't have an impulsive environment, then there is less evidence that this is a trending market. Again, I'm just sharing my way on how to trade. I would wait for the thick dot because now I do have evidence of an impulsive environment. The tool considers that probabilities are stacked in our favor in a greater way to be short. So right now, we just got a red dot changed from blue to red, and it's thick. So in other words, right now, if I was to plan a trade on gold futures, which we can do if we have time, I would be planning on shorting. Okay. Now, there is something else, which is the fact that it's blue or red and it's thick or thin tells you a lot about what to expect in the future from a statistical point of view. But at the same time, nothing lasts forever. So just like the old saying in Wall Street, which is the trend is your friend, and then some people will end that sentence by saying until the bend at the end. So the question is, when is the bend going to happen, right? When is the trend going to reverse and change? And this is where we now add some additional calculations, such as the max distance and the count, which is telling you what is normal in a down market. So because it's a down market, I would only focus on the red values. 1.23 ATRs, I will explain exactly what that number means in a moment, but 1.23 ATRs would be our definition of too far, too fast. So if a trending environment reached that level, the interpretation would be that while there is a trending condition and it just started and it's a thick dot and it's all confirmed and everything else, well, the fact is that the market is moving too far, too fast. And because it's moving too far, too fast, it's probably not sustainable. So then you pass. It's like you went out of the house, you want to go to the place, and it's rainy, so no trade. Even though you had a market condition which is defined, if you reach that value, the market may not be sustainable because it went too far, too fast. That's what we mean with max distance.
Jose, real quick, what is that being compared to? So the 1.23, you mentioned ATRs, average true range. Is that off of a kind of an index of like one would be normal, and because we're 1.23, and it might be less, right? It could be less than one, or...
Let me switch to another market because unfortunately there is a gray line showing up here in the bottom part, which brought this number to zero. This is actually not an ideal example. It was a few minutes ago. So let me switch to another futures market, for example, this one, and we will see this much better. In this case, we are looking at crude oil futures. We have blue and thick dot. So initially we would conclude you want to be a buyer, you have a statistical advantage to be a buyer. But now here I'm going to focus on the blue value. It's not 120 something, it's 0.97. Each market is different, right? So in this case, 0.97 is our definition of too far, too fast.
Okay.
Now 0.97 what? 0.97 ATRs away from an average. That's what that number means. At the speed at which this market is moving, we've moved 2.08 ATRs away from an average, where a 2-star deviation of what's normal, it's 0.87. In other words, this is kind of like a 4-star deviation of increase of volatility. Right. So this is definitely a case of too far, too fast. Yeah. And while it may keep going, because we've seen crazy things become crazier, probabilistically speaking, it's more likely going to reverse and probably in an aggressive fashion to the other direction because it's very much overextended.
It's like stretching a rubber band, right? You stretch that rubber band as far as, well, farther than you have in a while. And if you let go, it could snap back and go the other way.
Correct. So when assessing my step one, in this case, I would pass. I would not trade crude oil because I got a contradiction. Here it says go long and here it says too far, too fast. I will be like, okay, so I'm going to find another opportunity, or since I'm using a 15-minute time frame, just wait another 15 minutes and see what's happening in the next period, and then be ready to plan a trade. On the right, we have the count, which in this case is also not favorable. Why? Because a normal duration of a climate crude oil futures on a 15-minute time frame to the upside is 5 candles at a time. So each wave on the way up statistically lasts 5 candles, and each wave on the way down statistically lasts 8 candles. But in this case, we've been moving 11 candles on the way up, which is more than what's normal. In other words, we have a situation here where the market is moving in a way that is not normal and therefore potentially not sustainable. So if I was getting ready to trade crude oil, my answer to this potential opportunity would be to wait, because this market condition is not normal, therefore less predictable. So what do you do? Well, you go for another market. For example, we can look at the Dow Jones futures, for example. What do we have here? Here we have a situation where we have blue dot, thick. So I want to go long, but too far too fast is 108. We reached 2 ATRs, which is more. Normal duration 6, we reached 7. So this market climate has lasted longer than normal and has stretched more than normal. So same as crude oil weight. That would be the conclusion.
So another way to look at this is, yes, we've got kind of bullish conditions, but it's been bullish for too long compared to its history, right? So the probability that this could retrace, turn around is higher because we've been so extended and we're exceeding that window of kind of normality of how many bars we're used to being up, which is 6. Now we're at 7. Anything past 6 is considered maybe higher probability for a turning point.
You're correct. That's exactly it. And the beauty with the platform with NinjaTrader is that you can also have all these analyses put in a table format. So here, for example, we can see that this climate is sensible. So the S&P is going to give us a situation where we are confirmed 7 is less than 8. So the duration of the climate is less than what's normal. So we are not the last guy buying at the peak of an uptrend. We are still in a condition that makes sense. Mm-hmm. But unfortunately, it went too far too fast because 172 is more than 156.
Right.
So in that case, it's not an ideal situation. So we also have the Euro futures here, which is also sensible. Let's see what's happening. We do have an opportunity here. We got a yes here. We got thick and red. So we want to be sellers, ready to plan on a short. Too far too fast is 0.95, but the most we reached is 0.55, which is less. So this market never overstretched. It's in a sustainable window. Mm-hmm. And then the normal duration on the way down is 4 candles at a time, where we've been so far 3 candles in that climate. So we could pick on a trade and be at least 15 minutes experimenting the price moving in our favor. That would be 15 minutes or more, because it's 3 more minutes until 11:30 plus another 15 minutes. So, we could experience a valid opportunity. So if I had that, that's my step 1. But basically now, if I move to my other windows, here we got UFOs, which stands for on-field orders, right? So we got on-field orders to sell. So now I could wait for the euro to come into my red UFO, get short here with a stop above, and the expectation is we got sell on field orders at 107.705, and the climate is down, is not exhausted. So the expectation will be that from there, those sell on field orders will be quite powerful, and we may experience the market go down. You may want to take profits when you get to the green UFO, and that could be your trade. Just to be a bit more visual, if we were to document this, so we got 6E, if we get short, so 107.705, that could be an entry to go short. A stop would be located at 1.07725. We can be a bit more generous. Maybe we'll go at 30 just to give a little bit of extra breathing space. And then your target could be 1.07650. So in other words, you are running up 4 ticks in exchange to make 8, 65 to 73. So that's a 2-to-1. There are better trades than that. There are worse trades than that as well. But if that fits your trading plan, so that's an easy one to identify. You identify the climate, that's the step 1. You have a statistical advantage by being a seller. So then you just need to define your entries and your exits. In my case, I'm a UFO trader, so I use UFOs. It could be Fibonacci's, it could be support and resistance lines, it could be pairs of a Bollinger Band, you name it. As we said, there are many ways on how to trade, including many ways on how to do step 1. But again, the reason why I like the way I do it is because I just don't need to add thinking to the process, and therefore there are no human emotions as part of it. I just need to interpret the information that is given to me on the screen, which has only one possible interpretation.
Right. I think we should mention that it doesn't always follow through, right? You could have the current value be much less than the kind of extreme 2 standard deviation value, and it still might reverse, early and all that. But that's to be expected with any indicator, past performance not indicative. I think what this is doing is just saying, hey, there's something left in this trade. Would you rather participate now, or are you going to wait till it gets extended? You're not going to wait till it gets extended, so let's not even consider it. So that's what I really like about putting those pieces together. And then putting it in a market analyzer is so cool, right? Because then you can compare everything else, right?
Saves you time as well. It's like,
Oh, yeah.
like you have a radar, you know what to do. You don't need to go from one chart to another and spend time.
And I love going from chart to chart. I love looking at charts, especially when they're cool indicators. But you're right. You don't have time to go through, especially with what the futures market gives you. You can participate in different asset classes,
Right.
but it helps you focus on what's important.
Yeah. And again, probabilities is a reference. That's what it is. The challenge of a trader is to predict the future, and that can never be done with guarantee. No one knows the future for sure. It's all about having a solid reference that brings you an edge, that is meaningful, that serves you well. And there's nothing like probabilities for that. So now, of course, probabilities are there to be sometimes respected, more often than not. That's why they're probabilities, but also violated. Like here we can see examples of good and bad. So for example, here we got a blue dot right there at 115. Every time we got a blue climate, statistically speaking, it should last 4 candles. But guess what? The next one became red.
Right.
So that was a complete failed climate, even though probabilities suggested this was going to happen, it didn't. Or this example, you got a blue dot, you were expecting 4 candles saturation, and look at the amazing move that took place here. How many blue dots we got? 1, 2, 3, 4, 5, I don't know, 10, 12. Way more than normal. Again, the real market conditions will be fluctuating above and below what's normal. But using normal as a reference, I think, at least in my mind, is a very good starting point, because what are you going to use as a reference if it's not what's the one thing that happens the most often, which is what's normal?
It's the literal definition of normal, right?
Exactly.
Very great instructor. From your reputation and dealing with you both, we know that about you, Jose. So thank you for coming on.
Thank you so much.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.